All right, great. So today we are going to learn about put calendar spread. Okay, I'll just write it down over here. We are going to construct a trade. We are going to construct a live trade in it. And also, I am going to give you some tips on how to plan a put calendar spread. Okay, so has anyone traded put calendar before? Mastan, you said you have some experience in it. Have you traded any kind of put calendar spreads before? Monthly. All right. Okay, so let me just open Nifty option chain as well. Let's see what values we get to construct a good put calendar spread. So before constructing a trade, I'll just explain you for those who do not know what a put calendar is. In a put calendar, it involves two legs. Okay. Now the first leg is the buying leg. So you buy a put option. Okay. The second leg is the selling leg. That is, you sell a put option. Now, if you search on Google, the definition for put calendar is that you buy a put leg and you sell the same put leg of a previous expiry. Now, for example, what do I mean by that? That let's say right now we buy July end put option. Nifty is currently trading at 24,300. So let's just take 24,300 put option. Now, according to the definition, I have to sell 24,300 put option of any near expiry. By near expiry, I mean it can be 11th July, 18th July. Okay, I have these two options which I can sell, right? So this is of 25th July, and we buy the same P 24,300 PE of either 11th or 18th July. Okay. Now, this is the basic definition, right? But now I'll tell you the problem also what happens in this normal put calendar if you plan. Yes, you're right. You sell the near expiry. So, like your I have said, if you just go according to the definition, you buy a put option of monthly expiry. Let's take just for example's sake, and if I've written buy over here. That's why you've written that, right? So, and you sell the put option of 24,300 either of 18th or 11th July, right? Now let's see what the premiums are, and first let's understand what the maximum risk will be, right? Now, put calendar is a strategy which is IV dependent. Now, let's not go into the details of what exactly IV dependent is, but just remember this that the your payoff that comes in a put calendar spread, it depends on the IV. There is a factor that IV plays in it, right? Now let's now let's just take an example and first understand, considering that there is no IV dependency on the trade, we are going to take just one small example and we are going to see what is the maximum profit, where will be the maximum profit and where will be the maximum loss. Okay. So let's just come back to option chain. And then I'm going to give you advice or just you can say a tip of how do we plan put calendar spreads. But right now, let's just take a simple example. So 25th July, 24,300 is at 260. Let's say 24,300 plus PE as at 260. Now, basically, a put calendar is when you have a slightly sideways view. Okay. Now it depends where are you taking the trade. I mean, which strikes are you selecting? If you select at the money, basically, if you select where Nifty is trading at, we call that the spot price. If I select the strikes that are near to the spot price, I am basically having a sideways bias on the market. Okay. I'm going to explain it what different biases, how do you take different biases and plan a put calendar. But right now, just remember if you take at the spot price, that means you have a sideways bias. Now, so 24,300 plus PE is of 25th July. Okay. Is that 260? Now, near expiry. What is the near expiry? Let's take 11th July. Now, remember one more thing, like whichever strike you sell, it is always better to keep a gap between the expiries. By a gap, I mean after 11th July, initially your trade should be of July end and first week of July. Okay. I'll tell you all why it is important and how will it help you all. But just remember the bigger the gap, the better the calendar spread, right? So now, for example, over here, we are going to take the 24,300 of 11th July, right? 24,300 of 11th July is at of 11th July, that's 60 rupees. Okay, now if you go and check the definition of put calendar spread, you are going to get this where you buy a strike of a far expiry and you sell the same strike of a near expiry. And honestly, trust me, if people who have been trading, who have some basic idea of options, and if you have actually ever taken a put calendar spread, this always fails. This always fails. Okay. Now, why does it fail? Now, just try to understand one thing. Okay. Now, let's say we have a debit of 260 points. Okay. And we have a credit of 60 points. Okay. But this is of 11th July. Now, what will happen? I will make money in the trade when Nifty is at 24,300. My maximum profit is at 24,300. Now, why is that? Okay. Now, just to understand, just remember this. Why does a put calendar spread makes money? Okay. Because your near why put calendar makes money. Because your near expiry decays faster than your far expiry. Okay. Is this statement clear to everyone? What does this mean? Your near expiry decays faster than your far away expiry. Now, assuming that Nifty is at 24,300 by 11th July, so I am going to get 60 points in the credit leg that I have taken, but I won't be losing 60 points in the debit leg at 11th July. Is this clear to everyone? Before going ahead, I have to make sure that the statement is clear. Why does a put calendar make money? Because your near expiry decays faster than your far away expiry. Once, please, Masan, I didn't get your doubt. आपका जो नियर आपका जो नियर एक्सपायरी है 24,300 का वो जल्दी डीके होएगा कंपेयर टू 24,300 का 25th जुलाई का. सो आपका जो प्रीमियम है 11th जुलाई पे ये पूरा जीरो हो जाएगा. बट ये अगर निफ्टी 24,300 के आसपास ट्रेड हुआ तो इसमें 60 पॉइंट्स पूरा नहीं जाएगा. क्लियर हुआ ये स्टेटमेंट? Isaki, what scenario? So basically, Okay, now what I'm going to show you all is somewhere you won't see it on the internet, okay, or it's a we are using a put calendar concept only. But now where we use put calendar is if I'm either uh, neutral to the market or I'm bearish. Okay. In this normal case, what happens is if you take the buying leg and the selling leg of ATM, by ATM I mean when Nifty is trading at, you will only make money if the market is sideways. Okay. You will lose money in both the cases if it sharply goes up or if it sharply goes down. Okay. Now, where do we use put calendar spread? And how do we use, in fact, how do we use put calendar spread? Now, the only key that changes everything in the trade is that, remember the first statement I said, the more difference you have between the expiry dates, that is, your buying leg is, let's say, of month end and your selling leg is of first week of the month, right? The key that changes everything is that we take far away calendar spreads. Okay. Now, how will that help us? Let me just take an example first. And just remember the values. Okay. Now, we are going to see the live values over here, right? We are going to 25th July, right? Now, 25th July, 24,000 is at 143. Okay. Let me just come to 11th July first. 11th July is tomorrow, so there's no point of taking 11th July. Let's see if 8th August is liquid. 8th August is 24,000 is 220. Yeah, we can take this 220 and we are going to see 18th July. Okay, perfect. Okay, 1000 is 45. Now, what was the key? That if we take put calendar spreads at far away or slightly out of the money, at far away from the spot or slightly out of the money. Okay. Now just remember this. The far you take from the spot price, let's say Nifty is trading at uh where is this? Yeah. Nifty is trading at 24,300. Okay. 24,300. See, now whenever you plan a trade, just remember one thing. For loaning, okay, and to get the confidence of taking higher quantity, firstly, your risk has to be very minimum. Okay, you have to make sure if I'm planning a trade that if the market goes down, I start making money. If the market is sideways, I make money. And if the market goes up, I have a lot of time to change the trade, evolve the trade. And even if worst case, I'm not able to evolve it, my risk is very minimum. So what is the key? The far you go from the spot price, your risk becomes lower and lower. Okay. And now why is this put calendar spread? Like, this is one of my favorite strategy because your initial risk is very low. And if market starts coming in your favor, the MTM and the maximum profit is really high in it. Plus, you get a lot of chances to evolve the trade to get down the loss even more down what your initial risk is, right? So let's just take an example over here. Right now, Nifty is trading at 24,300. This is the spot price. Okay. So till now, is everyone with me? Are there any doubts till now? Whatever I've explained, are you all ready to see this? How do you plan put calendar spreads? And you all can try this on your own as well. Is everyone with me till now? Isaki, Mastan, Tushar. All right, great. So Nifty is trading at 24,300. Okay. Now let's just go to the near expiry. The least premium I want is, let's say, 20 rupees. Okay, 23,800. So first I always see the selling leg, 18th July. Where is this? 18th July, 23,800. 23,800 minus PE at 20, 18th July. Okay. And now we go to 8th August. Okay, this is not liquid over here. We have to change this. 1 second. Let's go to 1st August. Yeah. So now remember this, what I'm trying to explain, okay? You have 23,800 at 135, okay? Tomorrow when the market opens, you will get these legs liquid because uh it's already midweek of July and the first week of August will be liquid, okay? So let's consider this 134. Your 23,800 plus PE is at 134 of 1st August. Okay, now friends, you tell me one thing. Right now, your spot of August expiry, 1st August expiry, your at the money premiums are around 300 rupees. Let's consider 290. Okay. Your at the money premiums. Now just listen to this very carefully. Why I'll make money if the market goes down. Your at the money premiums are at 290 rupees. I'm considering at a cheaper price. Your ATM is at 290. 290. ATM of 1st August. Okay. And your ATM of 18th July is 137. Okay. ATM of 18th July is 137. Now, let's say, just remember this, I'm keeping it on the side. This is really going to get interesting now. Okay. My initial trade is what? 134 I have paid, 20 I have 134 my debit and 20 is my credit. Is that clear? 134 is my debit, 20 is my credit. Is that clear? Yes, perfect. So my maximum risk over here is how much? 104, 114. Sorry, 114 is my maximum risk. Like even if I'm just like not opening the screen and I'm not doing anything, 114 is my maximum risk. That is 114 into 25 is a lot size. 2,800, 2,850 is my maximum risk. Okay. Now, two things. Okay. 2,800 is my maximum risk, even if if my laptop is closed till the end of August, right? Now, two things again. If market starts going down, I have shown you all the ATM values. Right now, Nifty is trading at 24,300. Let's just assume it falls like 150, 200 points. Even if it falls, okay, I'm not even talking about closing. Right now, we are on 11th July. Just keep these things in mind. We are on 11th July. We have 1, 2, 3, 4. This is your 1st August. We have 4 weeks. How many of y'all would agree that 200 points fall in Nifty in 4 weeks is not a big thing? Is it challenging for Nifty to fall 200 points in 4 weeks? It fell 200 points today itself and it just came back. Okay. Now these are your reference values. Let's say if Nifty falls and Nifty comes to 23,800. Okay. Assuming if it, how much ever it falls. This is just the ratio that you get, like what the ATM values are. So assuming Nifty falls at 200 points or 250 points or even 100 points. Now these reference values, why have I taken? Because we are considering Nifty to come at 20 at our strike. Okay. Now if Nifty comes to 2300, your first August would become 290. Okay, now why is it helping us taking far away, buying the far away expiries? Is because your premium value will increase, your IV will increase, henceforth your 134 will become 290. So in this leg, you will approximately earn around 156 points. Is this clear why my 134 will become why I will make 156 points in this leg? Is this clear? Because right now ATM values are trading at 290. If perfect, yes. It's clear. I'm not going to repeat it again if it's clear, okay? Perfect. I'm going to make 156 points. And my 23,800 put of 18 July will be 137. So I'm going to lose 137 minus 20. I'm going to lose 117 points over here. My net gain will be 156 minus 117. 39 points will be my net gain. Okay. This is my net gain if market comes at 23,800. Okay. If it starts falling into 25, which is like 975. Okay. Now, just understand one more thing. Okay. Now, if Nifty starts coming down, if it starts coming down gradually, my 23,800 will start making money, correct? And if my 23,800 is starting to make money, and if Nifty comes gradually down, because this is of 18th July, if let's say Nifty starts coming down at these levels at 15, 16, 17, so this will not become 117. Okay, now what are, like, I'll show you the values right now. Your 11th July at the money puts are trading at 61. It's trading at 61, friends. So if it starts coming down to those levels, this is going to be 61. Just imagine I'm just going to lose 40 points over here. Are you all understanding what I'm trying to explain? The more time it takes to come down to those levels, this leg will make me much profit because it still has 3 weeks expiry in hand, and this leg won't lose so much. I'll be losing around 30, 40, 50 points in this, and I'll be making around 110, 120 points in this. Am I clear what I'm trying to explain? Okay, I'm coming to the chat box. Am I clear, everyone, what I'm trying to explain? Okay. Now, if Nifty is sideways, I'm still in a good position because this 20 will expire. This 134 is going to be, let's just check. 134 is going to be how much? There are 1, 2, 3, 4. So after 18, there are still 2 weeks. So we are going to check 25th July. For our reference value, our 23,800 is at 23,800 is at 95. Yeah, so 95, I'm going to lose around 11 points. I'll be losing if Nifty remains sideways. Okay, like wherever Nifty is trading at right now, I'm going to lose around 10 to 11 points, right? Around 250, 300 rupees. Now, again, why? Remember the first statement I said, the greater the difference, like 18 July and 1st August, there are 3 weeks in hand, the better the trade it is. Because if let's say Nifty starts going up, I have 18 July put legs over here I have 18th July, I have 25th July, and I have 1st August. I have 3 weeks of puts over here which I can sell to get the loss lesser, or I'll cover at least more than half of it. Is this clear? Why the difference is better? Because I'll be selling July and puts. I have first week of puts, then I have eighth. Okay, this is only first and 18th. So I have 18 July puts, I have July and puts, and I have 1st August puts to sell with me. Yes. So these are the kind of trades that we give on our platform. Okay, these, trust me, if you search for a calendar spread, you're going to get a boring calendar spread which will only make money on the expiry day, and even if the market is sideways. Okay, these structures and all, I have at least not seen anywhere on the net till now. And these are the kind of trades that we give, right? I'll just make you all go through the website once where, okay, so now whoever was new, I would just advise you all, we are providing free trades on a platform daily, right? And these are the kind of trades that we give. Okay, you don't even have to take the trades, you don't even have to, like, do anything. Just, just go on the platform, log in, and do the basic requirements that are needed. And after that, you just have to observe the trades that we give. So once you are on the platform, let me just take you through it once. So the platform's name is hedge.in. I think I am having some network issue over here. Yes, there is a mobile app also. The app is called Hedged. The name over here, HEDGED. It's there on Play Store, it's there on App Store, it's available everywhere. So over here, you will see that we are giving option strategies daily. What you have to do is, if you want to learn about the trades, you just have to go on the trade. You just have to track this. Okay, we are going to keep these. We keep these late night sessions daily at 9 p.m. where we explain every trade that we give. Okay, once you go to the trade, you track the trade. You will be notified about the trade. Okay, by notified I mean, if we are making any changes in the trade, if the trade doesn't go in favor, if we are booking profits, you will be notified about it. If we are doing any changes to the trade, you will be notified about it. So once you start observing these patterns, observing our styles of trades, which is, after a point you will see that there's a fixed routine that is followed, okay, and it is all mathematics, and there is no much brain, or there is no much bias that we take in the market. It's all based on what our algorithms provide with our premium values, and whenever there is a right time to enter an option trade. So these are the kind of trades that we take, and I would suggest you all to just track it once for education purpose. And for those who have the capital and for those who want to take the trades, we have different subscriptions where you are provided with different various trades, low risk, good return trades, and all sort of things. And also, like, because these sessions are not meant to promote any subscriptions over here, so I'm not going to talk much about it. And also we have different kind of subscriptions which allows you to take the trades directly. Like, you have that one click over here where your trade will directly be placed in your broker. So anyone who's interested in taking those trades, y'all can just put in your number and the team will contact you, and they'll just brief you about the different subscriptions and the plans we have. All right, I'll just close the session now. Thank you, everyone. I'll see you all in the next session.